Good morning and welcome to the Ascendis Health annual results for the full year 2018. And later on this morning, we're going to reveal the new strategic focus of Ascendis Health. So happy to see so many. I know you guys have been patient over the last few months since close period started and also over the last couple of weeks. So welcome also to a lot of investors from around the world and our Ascendis colleagues. We have a webcast live. And we're going to spend the next 45 minutes on the results. Going to have a break and then we'll come back and reveal the strategic focus of Ascendis Health. And you should all have booklets on your tables. So Kieran and myself are going to divide conquer. So here you see the presentation outline for the next hour and so. And let's start with a quick overview of the last 12 months in terms of our achievements and also learnings as a business. So on a comparable basis, and here we're looking at the previous period where we did not own the business, and if you compare like for like, our organic growth is 5% versus the previous year. Our EBITDA is within the target range at 17.3%. And it's growing 2% versus the previous year. On a normalized level, this is 18% growth. You'll also be pleased to see that our total gearing has decreased from 5 times to 4.4 times. And in particular, we are pleased about our ability to convert cash. We have exceeded our full year target quite far. In Europe, Remedica and Sunway continues to outperform the market. And Cytec, our sports nutrition business, which you do know we are turning around, we've already seen some early wins there. And we are going to talk more about Cytec when we come to the strategy later. Here in South Africa, we have seen different performance. Some of our businesses have done very well, and some have also been affected by the low economic growth and the consumer spendings. I think you're all aware of the macroeconomics, so I won't go too much into details. In a couple of areas, we also done some soul searching, because some of them are also self-inflicted, which we are addressing. Divestments, there we announced 3 divestments back in June at the pre-close, and 2 of them are now completed. Our normalized HEPS from continuing operations are up 2%. The normalized earnings are up 14%. And as you know, we have spent a few months conducting a strategic review as a business, which we concluded in June. We thought it was right to take stock of our M&A journey over the last 10 years and just regain strength as a business. We're also revealing here the performance versus the target we provided to the markets. As I said, 5% organic comparable, which is lower than what we expected of around 10%. EBITDA is flat versus the previous year. And our net working capital days, we are not yet at the target we set at 125. We ended up at 138 days. Though in the second part of the year, we did a much, much bigger job and improved on all the levers on net working capital. On cash conversion, we had a tough first half year. We only converted 50%, as you might recall. But the team across all business units, across many functions, finance, sales, procurement, etc., have done an amazing job. So we ended the year at 92%. And our gearing is on target at 3.4 times. Now lead the word to Kieran, who will take you through more details on the financials.
Thanks, Thomas. Good morning, ladies and gentlemen. Before I start my presentation, I'd just like to firstly thank all the members of the finance teams in the subsidiaries and at the group finance level. We had a challenging time this time around. We had implemented a new consolidation system called Cognos, which proved a little bit trickier than we thought, but we're happy that that system now is fully in place and operational, and we'll be in a position to present numbers in a timely and robust fashion going forward. If I can take you through the results, on a headline, as you can see, revenue up to 7.7 billion. That's 21% on a reported basis, as Thomas mentioned, 5% on a comparable basis. Tale of two different regions. We were very pleased with our European performance. On a constant currency basis, on a comparable measure, they grew at 9%, with the South African business on the same sort of measure, flat. So on an average, 5% for the group as a whole. Normalized EBITDA up 18% to 1.4 billion, 2% on a comparable basis. In terms of the restatements, you see we have got a couple of restatements in our financials. First of all, as Thomas mentioned, we had some discontinued operations. So we sold the sports nutrition business and the direct selling business, and we've changed our definition of normalization, as we had at our interims, where we no longer add back the notional interest on the deferred vendor liabilities. Looking at our revenue, as you can see, 21% growth. The European businesses grew 35% on a reported basis and now represent about 48% of our total revenue in the group. High growth businesses, and they're providing a good hedge against any rand weakness. We saw one acquisition come into the fold in 2018, and that was the Chiron Labs business, part of our animal health business. That became accretive from the 1st of March. And then we obviously had a full 12 months of revenue coming from the Cipla and Sunwave acquisitions, which were acquisitions that were made on the 1st of June 2017. Looking at our income statement, we see the effect of those acquisitions through all the different lines. So on the revenue line, and particularly on the gross profit margin line, we see a pleasing increase from 41.5% to 44.8%. All three of those acquisitions, Sunwave, Cipla, and Chiron, are very, very high gross margin businesses. Normalized EBITDA up 8.3% to give us an EBITDA margin of 17.3%. As you can see, operating expenses have increased 36%. Of that 36%, about 30% is because of those acquisitions, bringing those in. We decided to invest in marketing in a number of our consumer businesses to try and protect the top line. So there was about 2% of the growth, and then inflation and other was the remaining 4%. Looking at the bottom half of our P&L, we saw quite a big increase in amortization and impairments. That was as a result of Sunwave coming into the fold. About 25 million was due to Sunwave as well. And one of the big key audit matters that the audit teams focused on was impairment and impairment testing. And we saw about 30 million rand that we've impaired on continuing businesses. So it's included in that 227. We also saw an increase in finance costs versus last year with the increase in gearing that we had, particularly in the European businesses, and I'll take you through that split in a couple of slides. Taxation down to about 12.1% as an effective rate. And that's driven by three things. We saw the full year effect of the decrease in the corporate tax rate in Hungary that went down from 19% to 9%. We did some tax planning in Cyprus, and we've taken advantage of a notional interest deduction, which has helped lower the tax rate there in Cyprus. And then we had, as a result of some of the loss-making businesses, we took advantage of some assessed losses that helped lower the overall tax rate. So profit after tax up 15.2%. As you'll recall, in November and December, we did have a rights issue and a private placement. That diluted our overall weighted average number of shares by 12%. So on a headline earnings basis, we see headline earnings, normalized headline earnings up by 2%. I just wanted to take you through what we've done in terms of the impact of the discontinued operations. This time last year, we did have discontinued operations related to the Wynberg facility. Now, our intention was to consolidate the Ascendis facility and the Wynberg facility, as they were both under recovering on their fixed overheads. When we got into the project, we discovered that it would make a lot more sense to actually sell our Sando and keep Wynberg. So we've reversed the decision on that. So we've included Wynberg back into our continuing operations. We have not excluded our Sando from our continuing operations, however, as they don't qualify from an IFRS point of view to be treated as a discontinued operation because they're part of a reporting segment. But we've included the impact of that in our normalized EBITDA. And as you can see, we've removed sports nutrition and direct selling. Those two businesses, the transactions on those have been completed post-year end. Sports was effective from the 1st of August and direct selling the 10th of September, no longer part of the group. This is a slide that I'm particularly pleased about and proud of. I think, as Thomas mentioned, massive team effort from across the board, MDs, finance, both in South Africa and Europe. We saw last year we had a cash conversion of 70%. We've improved that to 92%. And that has mainly come around in the net working capital space. So massive improvement, which I'll take you through in the next slide. But as you can see, what's happened with our cash this year, we've generated 686 million. We spent a bit on CapEx. About 40% of that CapEx spend is actually in intangibles, improving our dossiers, new product launches that have been capitalized. We had our share raise during the year, and then we repaid 1.2 billion rands worth of deferred vendor liabilities, which has served to overall make our balance sheet a lot stronger and decrease our overall leverage. Looking at our working capital, as you remember, we went out from 70% at the end of June 2017 we went down to 50%, and now in all three areas we've improved, and pleased to say that our cash conversion is 92%. That was a combination of more aggressive collection, particularly in the private debtor space and the government debtor space. The government owed us a lot of money in December, and they came to the party, and we received a lot of the funds from the government back in May. We also saw some hard work being done around improving stock safety levels, stock optimization, and a number of SKU rationalization projects, both overseas and locally, to decrease those inventory levels. And that put us in a great position to be able to pay our creditors on time and then negotiate better terms. And we've seen some much better terms coming through, particularly in the medical devices space, where we've got big overseas principals where we've managed to extend those payment terms. Gearing, I think gearing was a concern for a lot of, particularly onshore investors. And what we've shown here is both our net gearing and our net gearing, including deferred vendor liabilities. And as you can see, the gearing has stayed flat at 3.4 times. That was what we had guided back in December. But on an overall basis, has decreased from 5 times to 4.4 times. A little bit of that and the increase in debt was driven by rand weakness. And now we see that our debt is about 70% of our debt is based in Europe. And as a result of that, our overall weighted average cost of debt has decreased from 6.7% to 6.3%. Incidentally, post-year end, we have managed to repay all of our quarter one deferred vendor payments. So those are out already. So here, this slide shows the cash flow planning going forward. So in Q1 2019, we have already paid that 228 million. So our gearing, overall gearing is currently at 4.2. Going forward, we can see that our capital payments on our debt start to increase as our deferred vendor payments go down, except for Q1 2020, where we see there's still 40 million euros remaining for the Remedica deferred vendor payment. We plan to repay all these commitments with a combination of cash generated from operations, and that's come as a result of further improvements that we foresee in the working capital space. And then obviously some of the proceeds from the sale from sports, from direct selling, and from the Ascendis factory sale, which is in progress now, will help fund some of these commitments. And then ultimately for the Q1 2020, we've embarked on a debt refinancing project, which we'll go into much more detail in the strategy session later this morning. That's everything from me. Thank you very much for your time.
So let's have a quick look at the operations. and the performance first in revenue. So as you can see, in Europe, we have been growing the revenue by 35% at a reported level, and less 12% at a comparable level, driven again by Remedica and Sunwave primarily. And if we just took Cytec out of the equation, that is in turnaround mode, we would have been growing 25% on a comparable basis. SA, South Africa, 10%, and we're not growing at a comparable basis. The 10% is driven by the Chiron acquisition. And Kieran already spoke about the group level, so 5% at an organic level. When it comes to EBITDA, again, Europe is taking the lead here, 27% reported and 9% on a comparable level. Again, if we took Cytec out of the equation, we will be growing the EBITDA in Europe by 31%. In South Africa, 10% reported and 3% at a comparable level. Let's have a quick look at some of our businesses, and as we did in March, on some of them we'll go a little bit more in detail to show you some of the detailed numbers for the businesses we own, especially in Europe. So let's start with the consumer brands. And what you also will see, which is new, we are going to introduce RONA, so return on net assets. It's a metric we started to use here in 2018 to measure the impact of CapEx and net working capital management on every level at the BUs. So it gives you a better indication of the return. As you can see on consumer brands in SA, the revenue is flat. We did have some supply issue in wellness. Our contract manufacturing, Kempur, did very well and grew the business. And our skin business has been declining in South Africa, mainly due to macro impacts, which is the salons in South Africa are reducing the number of doors, as we call it, on a sort of annual basis, which also has impacted our ability to drive growth in that business. However, for skin, we're also looking to grow outside South Africa and have a few focus markets in Europe. In wellness, we have a number of interesting launches to come. We have just launched an RX brand, and under Nemu, we also have a brand for a new audience called H-Well that we have just launched to the market. You can see on RONA, we are at 19%, which is driven by the EBITDA decline, obviously, and we feel it should be closer to 30%. On Cytec, we are also down by, in this case, by 9%. It is driven by lower volume in Western Europe. It is a competitive market, and we are still fighting in the turnaround to understand the consumer a lot better and be more relevant to the consumer. But that's early days. I'm sure you recall the whey protein cost of good increase last year. We are now back at previous levels, which is good news, but we're still slightly impacted by some stock levels we had at the higher price. I think what's interesting with Cytec now is we see some successful e-commerce and web store tests, so we are going direct to consumers. And our Amazon sales is up 5 times since a year ago. We've got our feet on the ground in some selected markets, so not just only being relying on distributors, but also having our own people on the ground in Western Europe. And also we took a bold decision and a tough decision with the team back in July to make us more lean in that business. And we also reduced the number of staff at Cytec. RONA here is 17%. Again, it should be higher, obviously, but we are at those good levels also because we have had a tight net working capital management and also had lower maintenance capex than actually was planned. And that helped us keep the metrics in the higher teens. Sunwave, our Romanian business, still the number 1 nutraceutical in Romania, actually increasing its share since last year, is still growing 44%. They're also investing into more people on the ground, and we're seeing those are paying back and also putting some more marketing investment in that. RONA, 41%. And again, that's driven by the robust EBITDA growth. And also, I think, reflective of a business that has very, very strong brands that are now resonating both with doctors but also with pharmacists and consumers. And then we have a low fixed cost infrastructure. All the manufacturing at Sunwave is outsourced. PharmaMed. Remedica, as I said earlier, is doing very well. It's growing top line by 18%, and our EBITDA is up 2 percentage points versus the previous year. Driven by very successful and fast-growing out-licensing, and also growth in Asia and in the Middle East. They have done an outstanding job in cash management, especially in the second half. So you see here RONA of 29%, both to do with the EBITDA improvement, and as I said, the working capital improvement in the second half. Despite that business model, which is a very flexible business model that requires stock levels as well, to be ready to turn around orders from customers, especially in the tender market. Pharma Leader, the business we bought in, or 49% of, in 2015, double-digit growth. We are very pleased with that, despite we had some supply issues in the latter part of this year, where we only had a single supplier, and obviously we have dual suppliers, but that did hamper the EBITDA margin as well. The innovation machine there is working very well, and we are expanding our innovations into more customers, into more markets. So, of course, expect that growth to continue. The RONA is 41%, so pretty robust, and again driven by the EBITDA growth. And also, again, a business with strong brands and low fixed costs. Medical devices and pharma. So we are down 3% at the top line. A lot of that is driven by the public sector here in South Africa, where we are down 12%. But EBITDA is improving. Our medical devices team have now launched the integration project, so they are now one team coming out of those 4, and now we are, again, the #1 medical device business in South Africa. The pharma business see big opportunities and continues to grow in our OTC segment, be it pain management, gastro, and cough and cold. RONA of 42% is driven again by improvement in working capital in the second part of the fiscal year, and low investment levels in PPE that are required to generate those returns. And finally, Fight to Vet. Animal health is growing 21%, driven by the Chiron and Cipla acquisitions, as Kieran talked about. We have seen an initial cost increase due to the Cipla acquisition that has hampered slightly the EBITDA, but we expect that to pick up again. 44% RONA, again working capital improvement, so you see what kind of impact that has on the return, and also low investment levels in PPE. Bioscience, flat top line and slightly down on EBITDA, while AfriKelp is performing very, very strongly, and it's a great business. We also saw that we need to reduce the number of SKUs to 4,500, and just initially had an impact on sales, and therefore also a slight impact on the EBITDA. We still see some overhang from the drought in terms of related stock in that business that we are dealing with. But we have a number of cost optimization projects, especially in the FMCG part of the business, that is going to help us. RONA 40%, and impacted by the same things as the other businesses. So that was it. I think I just want to summarize before we take your questions, and then we break. All in all, we believe this is a very pleased set of results, with improvements, as you have seen, on the cash and the gearing side, and something we want to continue. And we're going to share with you later this morning in the strategic update what our future targets are. Excellent performance in Europe, almost across the board, top and bottom line. With good performance in South Africa, but of course challenges in some areas of the business that we are addressing. Even areas that are out of our control, we're trying to make them in our control. So we believe we have very, very healthy roots to grow this business and take it on a new journey. and we'll share more 11:30. This presentation is also available on the website. Should be by now. And we are keen to take your questions. Thank you. There should be a mic. Any questions?
Thank you.
Yes, please.
Thank you, Mr. Thompson. If you will allow, I have a few questions, please. There's an item on the balance sheet, deferred vendor liabilities, which shows a reduction from the previous year of approximately 228 million. But the same item on the cash flow statement has a value of 1.22 billion. What explains those differences?
I'll take that. Good morning, Mr. Rosenberg. If you notice in the balance sheet, we split the deferred vendor liabilities between short-term and long-term. Right. So if you add the two together, take the difference away, that's what you get on the cash flow statement. So just to give you a little bit more color around that, we did our rights issue in December. We raised approximately 50 million euros to bring forward the payment. So that payment was only due in August 2019. 90 million euros is due in August 19. We brought forward 50 million of that, so there's still 40 million remaining.
Thank you. May I carry on?
Sure.
The next item is the intangible assets and goodwill. The balance sheet shows an increase of about 662 million. The cash flow statement shows purchases of 164 million, so there's a big difference there as well. But I take into account the comment you made on slide 12, which included capex of 413. Am I correct in saying that capex in this case is included in the goodwill? I would have thought that capex might go into assets.
Yes, you're correct. So capex is normally a combination of property, plant, and equipment, so fixed assets, and intangible assets. So the intangible assets that we generated internally via new product launches, where you get the opportunity to capitalize your development costs, are reflected as that 160 million. The difference that you've noted earlier relates to our acquisitions. So that was the acquisition of Chiron. Obviously, there's a lot of intangibles that get recognized upon that purchase. So you look at what you pay for the business, you look at the net asset value of that business, and the remainder you allocate to either goodwill or intangible assets, and that accounts for the movement on the balance sheet.
Finance expenses on the income statement stand at about 395 million, which is approximately 43% of operating profit. Your net debt position, as I can make out, stands at 4.806 billion. That is after the deduction of your cash, which is about 300 million more than last year. Can I infer from that that the finance expenses in the coming year are going to be no less than what they've been shown as 395, or in fact might even be a bit more?
They're likely to be a little bit more. So it's the annualized effect of the finance we raised to help pay for the Chiron acquisition. Not much more, because the balance there is that the notional interest that we're raising on the deferred vendor liabilities, which is included in finance costs, goes down as well. So that level is probably going to rise a little bit, but not increase that much more. You'll see from an interest cover perspective, the interest covers remain flat from June 2017 at 3.8 times, which we're very, very comfortable with.
And finally, please, there's an item on the balance sheet, current liabilities held for sale, at 164 million. What is the nature of those liabilities, and is the 164 million cost to the company?
No, so that relates to the discontinued operations, so to the sports businesses and to the direct selling businesses. These are the intercompany creditors between other businesses in the group and those businesses that we've disposed of. You'll notice in the current other financial assets, the top part of the balance sheet, we've also got debtors related to those for about 160 million. So the net of those two, they net off to pretty much zero.
I thank you.
Thank you.
Thanks. Hi, guys. Just a couple of questions. I was wondering if you could give us some CapEx guidance for 2019. And that's the first question. Secondly, the return on net asset numbers that you are quoting for each of the divisions, are they using a normalized number for the return metric? And then finally, can you give us sort of just an estimate of the consideration you expect from the biosciences division that you're divesting from?
I'll take all two, all three. I can take all three. So the first question around CapEx guidance. The facilities that we've purchased in Rumenica and Cytec are still fairly new, so not much CapEx required there. So we normally guide at a 2% maintenance for typically property, plants and equipment. But we are doing a lot of work, particularly in our pharma businesses in Rumenica, to improve and expand the existing dossiers. So we've guided a further 2%. So you're looking at about 4% of revenue as total CapEx guidance. What was the second question?
The return on net assets.
Oh, yes, sorry. They use the normalized earnings for that metric. And then the third one, we're not giving any guidance around possible price. We've just literally announced it this morning. We announced it to the staff at about 8 o'clock or 7:30 this morning, and we're going into that process now. So we can't actually guide on expected proceeds from there.
Okay. Thanks.
All right. Oh, there's one over here.
Hi, Thomas and Kieran. I just have one question regarding our transformation targets. I think we asked about this at the interim results. Can you just give us an update on where we are right now and what we're targeting and where we think we can improve some of our transformation targets?
Yeah, so I think part of the investment that we've had, you saw in those numbers there, part of it was driven to improve those targets. So we're waiting for our next certificate to come out. They were just waiting post these results, and we're expecting them to obviously improve. They're not where we want them to be, obviously, versus some of the bigger peers. A lot of the companies within the group have got very good BE ratings. The group as a whole, we still need to do a little bit of work in that regard. But we do expect an improvement of the next rating that comes out in the next couple of months.
Just to follow up on that, in terms of how we target this improvement, are we doing it in terms of procurement? Are we doing it in terms of ownership levels?
So I think we've pretty much maxed out in terms of points on ownership levels. We've done everything there. We've done everything on CSI. The big kind of low-hanging fruit for us now is certainly on procurement levels. So that's where most of the efforts will be focused.
There's one down here.
What proportion of product is manufactured in-house and how much is outsourced? And what are the geographies of the manufacture and outsourcing?
For the total group, about 40% is manufactured in-house. Traditionally, we haven't been a business that has a lot of manufacturing competence. I think that metric improved when we purchased Cytec and Rumenica. So actually, most of the in-house manufacturing occurs in Europe. So of that 40%, I'd probably say a good 60 to 65% is in our European manufacturing businesses. And obviously now with the proposed sale of our Sando, that proportion will actually increase in favor of Europe as well.
Where are you buying your stuff from?
We buy our raw materials and finished goods from all over the world. So for our medical devices businesses, we'll buy Olympus machinery from Japan, we buy it from Europe, we buy it from America. A large proportion does come from China, particularly in terms of API, packaging. A large proportion comes from China and India. Yeah.
No more questions? If no more questions, then thank you for your attention. I hope you're staying until 11:30, where we're revealing the strategy. And there's still coffee and snacks outside the room. So see you back 11:30. Thank you.